Okay, welcome back. If you hear any pianos in the background, that's my daughter practicing piano. Um, we left off talking about national saving with private saving and public saving. Now we're transitioning into a set of incentives. So if you're looking to incentivize, say, saving or investment, and what happens in the case of a government deficit, um, this is where the graphs come back into the conversation. Again, we're in chapter 13, looking saving investment in the financial system. And let's start out by talking about savings incentives. So say you're the government and you want to encourage people to save more. Okay? How might you do this? Okay, we have price and quantity. Remember, your price over here is interest rate. All right, your quantity. This is the quantity of loanable funds. Okay? Quantity of loanable funds. You have a supply of loanable funds, okay, and you have a demand for loanable funds. Okay, so people who want to make money by loaning money are suppliers, and then small businesses, governments, whatever, that need to borrow money, they're demanders. So how might you incentivize people to save more? Well, if you get people to save more, there's more for them to loan out through financial intermediaries like banks. So if people are saving more, the banks have more money to loan out. So when a small business comes in and proves that they're able to borrow money, the money is there. So you want to increase the supply. Well, how do we do that? Well, it's not directly on this graph, okay? It's indirectly on this. You offer an incentive. Okay? If you guys recall from the principles, people respond to incentives. So, for example, you give savers a tax break. Give them a tax break. All right? If you give savers a tax break for saving more people will save more money just to avoid taxes. All right? Now, this is a supply effect, so we're going to move to the right towards a lot. All right, so we got supply 2 here, supply of loanable funds 2, which actually drops the original interest rate down a little. So you have the added benefit of lower interest rates, which makes people want to borrow more money. So that's a demand effect. But the initial move is of supply. And then you, of course, naturally move the quantity of loanable funds in the market from Q1 out to Q2, and you achieve your goal. So you have to offer, say, a tax break to people to save. Now, here's kind of the crux. Okay, here's the little intricacy. Most people leave it right there. But if you lower interest rates on a national level, that's actually a disincentive to save. So remember, interest rate is a price that you pay to spend money you don't have if you're a borrower, but it's also the price you get to save money, i.e. let the bank use it. So you don't use it, you let them use it. It's the price they pay you for them to use your money. Okay? So if you lower interest rates, that's a disincentive in the long run for savers. So your tax break, the amount of the tax break, if you're designing this policy, must exceed the amount of lost interest when the interest rate decreased. All right, so that's something you got to keep in mind. Okay? All right, so now let's say you wanted people to invest more. All right, so what are we talking about there? Well, we're talking about an investment incentive. This is policy number 2. So this is policy number 1, saving incentive. Policy number 2, investment incentive. When we're looking at investment incentives, again, we're drawing our graph here, price and quantity. Price is interest rate, quantity is quantity of loanable funds. And we have our suppliers of loanable funds, and we have our demanders. Okay? Supply loanable funds, demand loanable funds, LF, if you can't quite see it. What we're trying to do now is we're actually trying to increase demand. So we want people to invest. This is particularly true when you start thinking about businesses. small business, medium-sized businesses, big businesses, local government, national government, whatever, they want BMW to expand their plant. If they expand their plant, if they hire more people, incomes go up. If incomes go up, people in your local area are gainfully employed. They can pay taxes, and taxes can buy things for the government. Ergo, government wants people to be gainfully employed. Thus, they want businesses to expand. All right? But to expand, they have to take out loans. All right? So to take out loans, that's a demand shifter. All right? You want them to shift their demand. So if this is 0 and this is a lot, you want them going towards a lot. All right? So you got demand number 2 here. And what that does to your interest rate, it moves it from interest rate 1 and interest rate 2. So interest rates actually go up. Now we'll talk about that here in a second. But again, you move from Q1 to Q2. Okay? So you got the movement that you wanted. You get more investment. So you have to offer an incentive. To get more investment. All right. Example there. Taxes again. Okay. Offer tax breaks for companies to invest. All right, offer tax breaks for companies to invest. Now that said, that long run movement of that demand curve out to the right actually pulls up interest rates. So if you pull up interest rates, it actually becomes more expensive in the long run to borrow money, which is a disincentive to invest. So again, the amount, all right, of the tax break has to exceed the amount of additional cost due to the increase in interest rate. Okay, same thing that we had here. All right, so when you're designing this policy, you have to be quite wise about it. All right, hope this makes sense so far. The third policies. It's not really a policy, as it is just an occurrence. The United States, we'll just use our own country as an example. We typically spend more money than we have. G is government spending, T is taxes. Taxes are the only form of income for a government. So when G exceeds T, you have what's called a government deficit. Okay, if you have a government deficit, it only can be covered one of 2 ways. First way is quantitative easing. Basically, we print more money. Our monetary policy is to print more money. Money becomes less scarce, which makes it less valuable, meaning it takes more dollar bills to buy a loaf of bread. Whew! That's like everyone taking a pay cut because it's called inflation, and inflation is like a tax. It takes money out of your wallet and less stuff you can put in your buggy at Costco. All right, so assuming we don't do quantitative easing, we can borrow money. Okay, so we look at our as a country, we borrow money. We look at our price and our quantity. Again, we're looking at loanable funds, and we're looking at interest rates here. Okay, that's our price. We've got a supply of money, of loanable funds. We've got a demand. Okay, if you or I go and take out a loan, it doesn't really move that demand curve. But one of the most powerful economies in the world takes out a loan because we've got a spending problem. That's a significant shifter of demand. Okay, that's a big impact. So we're going to move towards a lot. If we shift demand in that way, okay, you have a few implications, just like you had right here with the shifted demand. Okay, you can increase interest rates, you can increase the quantity, and you actually, in the long run, because interest rates are so much higher, you punish investment. But when you look at the effect of a government deficit in the interim or intermediate time, it's actually an issue of supply. In that, if if the government is spending more money than it has, then if you recall from the last video, national saving, okay, national saving goes down, okay. Sorry, my computer went to sleep. I had to come back over here and wake it up. National saving goes down. If the amount of saving goes down because the public sector is not contributing to savings, that's actually a supply issue. So while initially you might think it's the demand issue and that the country is a hard shifter of demand, and there's certainly that aspect, the way I want you to look at it is from that national saving. So if you've watched the second lecture video where we talk about national saving, saving actually goes down. Now, we remember that saving actually equals investment from the first video of this chapter. If investment goes down, because saving goes down, that's a supply issue. So you're actually looking at a hard break this way, okay, on saving. All right. So if this is supply curve number 1, this is supply curve number 2. You still have that increase in interest rate, which is that thought experiment we just did there, okay, and that interest rates go up. All right, clear out a little space here so you can see. But the quantity of loanable funds go down. So there's less money to be had, all right, in a market that is being crowded out by government. That's actually one of the terms at the end of the chapter is called crowding out. If a government is a heavy player in a market for loanable funds, even globally, they'll take a lot of the funds away, and it results in crowding out. All right, so essentially what you've seen here in the reading is figures 2, 3, and 4. 2, 3, and 4. This is saving incentive is figure 2. This is figure 3. This is figure 4. All that you're going to see on the homework. And I cannot stress enough the importance of the reading. The supplemental videos, which are my voice over PowerPoint slides. I know they're just enthralling, but you know what, so are these. But I'm just offering these as a supplement to try to help you get through. Hope you guys are taking care out there. Wash your hands. Be safe. See you next time.